Capital is rarely lost because returns were too low. It is lost because the structure holding those returns could not endure time, volatility, and human constraint at the same time. Over long horizons, preservation is less about being right and more about remaining solvent, liquid, and behaviorally stable. That framing is deliberately unfashionable, because most conversations about long-term outcomes collapse into a single idea: selecting good investments. Selection matters, but it is often treated as the primary driver when, over decades, the decisive variable is usually quieter. The part that governs most long-term stability is not easily seen in performance tables, and it is rarely discussed directly. It is portfolio structure. In other words, allocation is not a detail, it is the operating system. The reason this matters is that long-horizon capital is exposed to more than market risk. It is exposed to sequence risk, the order in which returns arrive. It is exposed to liquidity risk, the need for cash at the wrong moment. It is exposed to behavioral risk, the tendency to abandon a framework precisely when the framework is most needed. It is exposed to institutional risk, where leverage, concentration, or inflexible liabilities turn ordinary volatility into permanent loss. Over 20 or 30 years, these risks do not arrive politely, one at a time. They overlap, they interact, and the portfolio structure determines whether those interactions remain survivable. Return and durability often move in opposite directions in the short term. Many strategies look intelligent during stable conditions. Some look mathematically superior in backtests. But durability is not proven by what works when conditions are friendly. Durability is proven by what continues to operate when conditions are inconvenient, when correlations shift, when liquidity becomes scarce, and when decisions must be made under constraint. The framework that clarifies this starts by separating two objectives that are often blended together without noticing: generating return and keeping capital intact. Both matter, but they are not the same problem, and they are not solved by the same design choices. Three common explanations dominate discussions of long-term protection, and each contains truth while still failing to explain the full pattern. The first explanation is diversification, understood as owning many things. That is a start, but it is incomplete because diversification is not a count. It is a relationship. In stress, relationships change. Assets that were previously distinct can suddenly move together. Correlations compress. The portfolio that felt diversified becomes a single exposure in disguise. The issue is not that diversification is useless. The issue is that diversification is often measured in calm conditions and assumed to persist under pressure. The second explanation is quality, understood as owning the best. Quality helps, but it is not a shield against valuation risk, regime shifts, or liquidity constraints. A high-quality asset can still experience multi-year drawdowns. It can still become a forced sale if cash is needed. It can still be embedded inside a structure that creates liquidation pressure at the wrong time. Quality reduces certain risks. It does not replace structural durability. The third explanation is discipline, understood as staying the course. Discipline matters, but treating it as the primary protection mechanism is another incomplete answer. Discipline is not a trait that exists in isolation. It is a property of the environment the portfolio creates for the investor. A structure that produces drawdowns larger than its owner can tolerate is not protected by discipline. It is undermined by design. The more useful question is not whether discipline exists in theory, but whether the allocation structure makes discipline feasible when conditions become psychologically and institutionally difficult. With those partial explanations set aside, the analysis becomes simpler. Long-run protection can be understood through a sequence. Allocation decisions, the second-order effects those decisions create, and the consequences that unfold over time. Start with the decisions. The first decision is not which asset is most attractive. The first decision is what role each portion of capital is intended to play. Over long horizons, most portfolios implicitly combine three functions: participation in growth, generation of income, and stabilization through adverse regimes. Those functions can be expressed in many ways, but the underlying roles are consistent. When a portfolio lacks clarity about roles, it tends to behave like a single bet wearing multiple labels. The second decision is the volatility profile the capital structure can absorb without forcing action. Volatility itself is not the enemy. Volatility becomes destructive when it triggers liquidation, abandonment, or structural breakdown. The portfolio's capacity to remain investable through uncomfortable paths is not an aesthetic preference. It is a core determinant of whether compounding is allowed to operate uninterrupted across cycles. The third decision is liquidity and flexibility. Liquidity is not only about convenience, it is about optionality under stress. Long-horizon investors often underestimate how frequently life, institutions, or operating constraints demand cash at moments that do not align with market conditions. The portfolio's structure determines whether those demands are manageable or whether they become catalysts for selling into weakness. Now consider the second-order effects. These are the effects that are not visible when only average returns are examined, but they dominate outcomes across extended horizons. The first second-order effect is path dependence. Two portfolios can have identical average returns and still produce materially different long-term results because the order of gains and losses interacts with withdrawals, rebalancing, and behavior. A large drawdown early forces recovery from a lower base. Even if returns are strong later, time is finite, and the lost compounding from a reduced base cannot be fully recovered. This is not a theoretical nuance. Over decades, the path is part of the return. The second-order effect is the interaction between volatility and forced selling. A portfolio can tolerate volatility as long as it does not create a moment where the owner is compelled to sell. Forced selling can be caused by explicit leverage and margin requirements, but it can also be caused by implicit leverage, fixed liabilities, spending commitments, concentration, or illiquidity that prevents raising cash without liquidation. In that moment, the portfolio's future return potential becomes irrelevant because the capital base is impaired permanently. Over long horizons, the cost of permanent impairment is magnified because compounding must restart from a smaller number. The third second-order effect is hidden concentration. Concentration is not only holding one asset, it is holding multiple assets that share the same underlying driver, the same macro regime, the same funding condition, the same liquidity environment, the same sensitivity to rates, growth, or credit. A portfolio can appear diversified by labels while being concentrated by mechanism. Over decades, regime shifts are not rare. They are inevitable. The portfolio does not need to predict the shift. It needs to remain functional when the shift occurs. The fourth second-order effect is rebalancing behavior, whether explicit or accidental. Allocation determines how capital is redistributed after relative movements. If a portfolio has no structural mechanism to prevent winners from becoming dominant, concentration can build slowly without being noticed, precisely because performance looks strong in the period where concentration is being rewarded. Conversely, a structure that restores intended proportions can reduce the probability that the portfolio becomes a single bet by drift. Over long horizons, this matters because the conditions that reward concentration tend to change. Once these second-order effects are allowed into the analysis, the consequence becomes clearer. Capital is protected when the structure minimizes the probability of irreversible loss, not when it maximizes the probability of being correct over the next 12 months. This is the point where return generation and durability must be separated with intent. Return generation is about participation in risk premia and growth. Durability is about staying in the game through adverse paths without structural failure and without behavioral capitulation. A portfolio designed only for return often assumes durability will appear automatically. Over decades, durability must be engineered. This is where the hidden role of asset allocation becomes visible. Allocation is not just a distribution of percentages. It is a design choice about how the portfolio behaves across multiple states of the world. It determines how volatility is experienced, whether drawdowns remain survivable, whether liquidity needs are met without damage, and whether the investor is placed into an environment where decisions remain stable under pressure. The reveal is straightforward but often overlooked. Over long horizons, structure dominates selection. Selection can add incremental value, but structure determines whether the portfolio remains investable across regimes. A fragile structure can destroy the benefit of good selections through forced liquidation, correlation compression, or behavioral abandonment. A durable structure can absorb imperfect selections without becoming terminal. From that point, evaluation changes. Instead of asking which asset is most compelling, the more durable question becomes how the structure responds when prevailing assumptions fail. Instead of focusing on isolated returns, attention shifts to portfolio-level behavior, drawdown depth, recovery time, liquidity resilience, and the likelihood that the structure will demand action at the worst time. Stability is not the absence of volatility. Stability is the ability to withstand volatility without being structurally compelled to convert temporary loss into permanent impairment. The implications are restrained but decisive. Leverage becomes less attractive when viewed through the lens of ruin probability rather than expected return. Concentration becomes less attractive when viewed through the lens of regime shifts rather than conviction. Illiquidity becomes less attractive when viewed through the lens of unscheduled cash demands. Even the meaning of risk becomes more concrete. Risk is not a single number like volatility alone. Risk is the likelihood that the structure will fail under plausible combinations of conditions. A durable allocation structure does not need to be perfect. It needs to be resilient enough to remain investable. It must tolerate being wrong for extended periods without breaking. It must tolerate stagnation without triggering unnecessary structural changes. It must tolerate volatility without requiring liquidation. The protection mechanism is not brilliance. It is endurance engineered into the portfolio's architecture. Over decades, compounding does not reward intelligence in isolated moments. It rewards continuity. Continuity is produced by structure. Capital grows when it survives.